What if the real threat to your wealth isn't a future crash, but a silent decline already happening right now? Because, while most people are busy arguing about the next interest rate cut or the next election cycle, something much bigger is unfolding underneath the surface. The dollar is slowly losing the absolute dominance it once had. And honestly, this isn't coming from fearmongers. It's coming from serious signals. Rising U.S. debt, geopolitical realignment, and major economies quietly preparing for a world where the dollar doesn't play the same role. Even Warren Buffett, one of the most optimistic investors alive, has started sounding cautious. Not panicked, just realistic. And when the world's greatest long-term investor becomes careful, the rest of us should at least pay attention. Today, we're breaking down Buffett's 5 most reliable assets to protect your wealth if the dollar weakens, and how ordinary investors can position themselves calmly, logically, and without fear. Because this video isn't about panic, it's about preparation. Most people imagine a currency crisis as a dramatic event, markets crashing, headlines exploding, everything happening overnight. But the real danger to the dollar is much quieter. It's slow, steady, and almost invisible unless you know where to look. For over a decade, the US has been printing money at a pace that would have been unthinkable in the past. Trillions created in response to crises, layered on top of trillions in long-term obligations. All while national debt pushes past levels that used to trigger alarms. The result isn't an immediate collapse, it's a gradual decline in purchasing power. Groceries cost more, housing costs more, savings buy less. The erosion is happening in real time. Meanwhile, global behavior is shifting. Some countries are exploring ways to settle trade without the US dollar. Others are reducing their dollar reserves, not loudly, but quietly, step by step. It's not a full-scale exodus, but it's enough to signal that the world is preparing for a more diversified future. None of this means the dollar is doomed tomorrow. The US still holds enormous economic strength. But it does mean the environment is changing, slowly, silently, and permanently. And the greatest threat to your wealth isn't fear, it's being unprepared for what comes next. For most of modern history, the dollar hasn't been powerful because it was backed by gold. It's been powerful because it was backed by confidence, the world's belief in America's stability, its economic engine, and its rule of law. Countries held dollars not just for convenience, but because they trusted the US more than they trusted anyone else. That confidence has been the real anchor of the dollar. It's why nations use it for trade. It's why investors flee to it during crises. It's why the dollar has remained dominant long after the gold standard ended. But today, some of that trust is being quietly questioned. Not loudly, not urgently, but gradually. Commentators, economists, and even former central bankers have pointed out a shift in tone. They're not predicting collapse, but they're acknowledging something new. The world is no longer blindly assuming the dollar's dominance will last forever. Rising debt, political gridlock, and unpredictable fiscal decisions have created a sense of uncertainty. And when confidence weakens, even slightly, currencies can move in ways few people expect. Because in a fiat system, value doesn't disappear slowly. It can shift suddenly when belief cracks. This isn't about fear. It's about recognizing that the dollar's greatest strength has always been trust, and that trust is now being tested in ways we haven't seen in decades. When the value of a currency weakens, most people think about buying gold, crypto, or foreign assets. But Warren Buffett takes a different approach. He buys the producers, the companies that actually create value in the real economy. Because if the dollar falls, strong businesses don't fall with it. They simply raise prices. This is the power of a moat business, a company so essential, so trusted, and so deeply embedded in daily life that customers keep buying no matter what happens to the currency. Brands like Coca-Cola, Procter & Gamble, and Visa have one thing in common: pricing power. When costs rise, they adjust. When inflation hits, they adjust. When the currency loses value, they adjust again. You're not holding money, you're holding the machine that prints money. And there's a hidden advantage here. Businesses with strong moats can raise prices faster than currencies lose value. That means your investment can outpace inflation instead of being eaten alive by it. Of course, some critics argue that megacorporations have too much control, that their ability to raise prices contributes to the very inflation they're protecting you from. But whether you agree with that or not, the reality is this: companies with global reach and dominant brands have survived every currency cycle in modern history. And while they're powerful, they're not the only assets built to outlast weakening money. The next category goes even deeper into long-term protection. One of Buffett's most overlooked strategies is built on a simple idea. When inflation rises, the cost to build new assets skyrockets, which makes old assets instantly more valuable. It's called replacement cost, and it quietly protects wealth when currencies start losing power. Imagine a railroad built decades ago. The steel, the labor, the land, all purchased at old prices. Today, replacing that same railroad would cost multiples more. But here's the twist. The original owner doesn't pay those new costs, yet the market prices the asset as if they did. The same thing happens with utilities, pipelines, energy infrastructure, and even certain types of old real estate. Inflation doesn't destroy these assets, it inflates their value. Every year costs rise, the replacement value climbs, and investors who own the existing assets get the upside without spending a penny. That's why Buffett loves capital-intensive businesses with long lifespans. They turn inflation, a threat to most people, into a quiet tailwind. But while replacement cost protects the value of what already exists, the next asset class focuses on something even more powerful: resources the world can't live without, no matter what happens to the dollar. When currencies weaken, people rush into metals, bonds, or anything that looks safe. But throughout history, one asset has quietly outperformed almost every form of money: productive land. Because no matter what happens to the dollar, the euro, or any currency on Earth, humans still need one thing every single day: food. And that's where farmland becomes a powerhouse. Over the past 2 decades, farmland prices have climbed steadily as the world faces rising food demand, unstable supply chains, and growing fears about future scarcity. Every drought, every shipping delay, every geopolitical shock reminds us that food isn't guaranteed, and productive land becomes even more essential. In financial circles, there's been a lot of buzz about billionaires quietly buying massive tracts of farmland. Some say it's a bet on future food shortages. Others claim it's a hedge against currency decline. Whether those theories are right or not, the timing is interesting, especially as global uncertainty rises. The real strength of productive land is simple. It doesn't rely on currency value. A farm can grow crops, raise livestock, and generate income whether the dollar is strong or slipping. Food prices tend to rise with inflation, and the land producing that food often gains value even faster. And while farmland is a powerful hedge against a weakening dollar, Buffett's next asset focuses on something equally essential, but far more scalable. When a currency loses value, the prices of essential commodities rise first, and food is at the top of that list. Wheat, corn, soybeans, beef, and timber don't vanish just because the dollar dips. In fact, they become more valuable in nominal terms, reflecting the reduced purchasing power of money. This is why productive farmland often outperforms other assets during periods of inflation or currency weakness. It produces something the world cannot go without: calories, fiber, fuel, and those outputs gain value automatically when prices rise. It's not speculation, it's the arithmetic of survival. Global demand pressures amplify the effect. Population growth, shifting diets, and climate-related disruptions mean the land that reliably produces essential commodities becomes a scarce and highly sought-after resource. As a result, farmland's market value climbs even as paper money loses purchasing power. Investors who own productive land are effectively holding a direct claim on the real economy. The more indispensable the production, the more resilient the asset. And while farmland secures wealth through the bounty of the soil, not all safe assets require dirt beneath your feet. The next category protects wealth in an entirely different way, yet just as effectively. Some assets generate value quietly without flashy headlines, and honestly, few do it better than critical infrastructure. Railroads, pipelines, electric grids, and nationwide communication towers are the backbone of modern commerce. Every shipment, every kilowatt, every data packet depends on them. They are, in effect, the toll booths of the economy. What makes them extraordinary as a hedge against a weakening dollar is that they are almost impossible to replicate. Building a transcontinental railroad, a nationwide pipeline, or a fully connected power grid from scratch is unimaginably expensive, heavily regulated, and legally complex. No competitor can simply copy it overnight. That creates a durable monopoly and immense pricing power. Speculation has been growing quietly in financial circles about who truly controls these assets and how shifts in policy or ownership could impact national security and economic resilience. Whether it's a concern over foreign investment, regulatory changes, or consolidation, these discussions underscore how critical infrastructure is both valuable and sensitive. Even better, these assets adjust automatically during inflation. The cost to replace physical networks rises with prices, while regulated tariffs or service fees often scale upward, protecting cash flow and asset value. Owning infrastructure is like owning the arteries of the economy, essential, resilient, and capable of thriving even as currency values fluctuate. And while infrastructure secures wealth through its indispensability, the next asset expands protection beyond U.S. borders, tapping into the global economy. One of the most underappreciated aspects of critical infrastructure is how its revenue often automatically adjusts with inflation. Utilities, pipelines, railroads, and other essential networks frequently operate under regulated frameworks or long-term contracts that allow them to raise fees as costs increase. In simple terms, when inflation rises, they don't suffer, they charge more. Electricity rates, tolls on pipelines, or freight fees on rail lines can climb alongside the general rise in prices, preserving profitability and protecting investors from the eroding power of a weak dollar. This is why infrastructure isn't just a stable asset, it's a naturally hedged asset. It thrives when others falter. Its cash flows remain predictable, its value rises with replacement costs, and it provides a tangible anchor in an uncertain economic sea. But there's a bigger picture to consider. What if the threat isn't confined to the United States? What if the world is quietly shifting toward a more multipolar currency system, where reliance on the dollar slowly diminishes? To protect wealth in this evolving landscape, investors need to think globally. That's where foreign assets and currency diversification become critical, the next defensive asset in Buffett's playbook. Up to this point, we've focused on assets rooted in the United States, but Buffett's strategy doesn't stop at national borders. One of the most powerful hedges against a weakening dollar is owning productive assets abroad, companies that earn revenue in stronger or more stable foreign currencies. Diversification isn't about abandoning the United States, it's about reducing concentrated risk. If all your wealth is tied to the dollar, a severe decline in its value would hit you disproportionately. But foreign assets generate real earnings independent of the United States currency, giving you a natural buffer. There's been quiet speculation in financial circles that global trade patterns are gradually shifting. Some analysts claim more contracts are being settled in euros, yuan, or yen, signaling that the dollar may gradually lose its near-exclusive role as the world's reserve currency. Whether this happens overnight or unfolds slowly over decades, the implications are clear. Currency exposure matters. When you own companies based in Switzerland, Japan, or Germany, your claim is on real earnings denominated in foreign money. If the dollar weakens against those currencies, the value of those earnings rises automatically when converted back into dollars. You get a dual advantage: growth from the company itself, plus a hedge through currency appreciation. This approach isn't speculation or gambling on foreign markets. It's rational risk management, extending Buffett's principle of owning productive assets into a global context. And while foreign assets protect against currency risk, the final defensive asset is the most personal and portable of all. There's growing chatter in financial circles about the long-term stability of the United States dollar. Some speculate that initiatives by BRICS countries, experiments with central bank digital currencies, and rising geopolitical tensions could gradually shift global reliance away from the dollar. It's important to stress, These are rumors and observations, not certainties. No one knows how quickly, or even if, such shifts will materialize. But the whispers are enough to make a careful investor think about diversification beyond traditional dollar-denominated assets. The idea is simple. The more alternative currencies gain traction in trade and finance, the greater the potential impact on dollar-based investments. If these trends continue, even a small erosion of dollar dominance could amplify the importance of holding productive, income-generating assets outside the United States. Yet even as you diversify globally, there's one form of wealth protection that cannot be outsourced, bought, or regulated. It doesn't rely on infrastructure, farmland, or foreign currencies. It's entirely in your control, portable, adaptable, and universally valuable. Because when everything else is uncertain, this asset remains resilient. The next and final category in Buffett's defensive playbook is human capital, your own skills, knowledge, and earning power. The final and arguably most powerful asset in Buffett's defensive playbook isn't something you can list on a balance sheet, buy with a broker, or hold in a vault. It's you, your skills, knowledge, and capacity to create value. Human capital is uniquely resilient because it adapts to any economic or currency environment. A talented doctor, engineer, software developer, or farmer doesn't suddenly lose worth if the dollar declines. Their expertise, problem-solving ability, and ability to produce tangible results remain in high demand, no matter what currency is used to pay them. Investing in human capital means continuously learning, mastering your craft, and expanding your problem-solving toolkit. It's about building a professional network, developing specialized knowledge, and creating services or products that people genuinely need. Unlike paper assets, your skills cannot be inflated away or devalued by monetary policy. Some say human capital is the real currency of the future. In a world dominated by financial speculation and fleeting digital tokens, the ability to generate meaningful, tangible value may be the most portable, secure, and inflation-resistant asset anyone can hold. When combined with moat businesses, productive land, critical infrastructure, and diversified foreign holdings, investing in yourself ensures you're prepared for virtually any financial scenario, from moderate inflation to a deep, sustained dollar decline. In the end, it's not about fear. It's about control, adaptability, and ownership of what truly produces value. The thread that ties all 5 of these defensive assets together is simple but profound: ownership. Buffett doesn't just buy stocks, land, or infrastructure. He buys pieces of the productive engine of the economy. He invests in assets that create value, generate cash flow, and adapt to changing circumstances. Whether it's a wide moat company, fertile farmland, critical infrastructure, foreign earnings, or the skills within your own mind, the principle is the same. Focus on what produces, not on what merely stores nominal currency. These are rational, enduring assets, and they are your shield against uncertainty. This philosophy isn't about panic. It's about preparation. Calm, deliberate, and forward-looking decisions can position you to benefit from changes in currency value rather than be victimized by them. It's a mindset that survives every economic storm because it is rooted in real, tangible, and adaptable sources of wealth. So ask yourself, are you simply holding cash, hoping for stability, or are you actively owning the future, the businesses, land, infrastructure, foreign assets, and skills that will continue producing value regardless of what happens to the dollar? Because in the long run, it's not fear that secures wealth, it's the ownership